President Bola Tinubu has praised Mr. Oluyemi Cardoso for leading reforms at the Central Bank of Nigeria, saying his policies are helping to rebuild Nigeria's economy for long-term growth. Speaking after the March 31st, 2026 deadline for bank recapitalization, President Tinubu described Mr. Cardoso as committed and focused. Specifically, he said the reforms, including foreign exchange changes and tighter financial regulations, have improved investor confidence and strengthened the system. We have more in this report.
The Central Bank of Nigeria, CBN, being the apex bank in the country, has one of its key objectives to promote a sound financial system stability. The CBN ensures the safety of soundness of the financial system in Nigeria through banking sector reforms, improved access to finance, identifying, monitoring and assessing vulnerabilities in key nodes of the financial system, adequate institutional capacity building, and implementation of good corporate governance practices. The CBN, in furtherance of this objective through a circular dated 28 March 2024, announced recapitalization of the banking sector and prescribed an increment in the minimum capital requirement for commercial, merchant and non-interest banks in Nigeria.
It was obvious that our banks post-COVID had been carrying on the forbearance period for too long, and the headwinds that lies ahead calls for the need for a proper assessment and a determination of the appropriate minimum capital requirement for banks. As such, the management of the central bank, led by Mr. Oluyemi Cardoso, decided that it was necessary to raise the minimum capital requirements of banks for the banks with international authorization to 500 billion, those with national authorization to 200 billion, and those with regional authorization as well as merchant bank to 50 billion, and while national non-interest banks have a minimum required capital of 20 billion and the regional non-interest bank 10 billion.
Recapitalization policy is not a novel concept in the Nigeria banking system. The sector has witnessed several recapitalization processes, with the last of it in 2004 when the CBN announced an upward review of the minimum capital requirements to 25 billion naira for commercial banks with a deadline of 1st January 2006. After the exercise, the Apex Bank confirmed that 33 banks have met the revised minimum capital requirements under its recently concluded recapitalization program, marking a major milestone in efforts to strengthen the country's financial system.
It's a different thing to raise the capital. It's another thing for the central bank to verify and ensure that those the capital raised are raised in accordance to our rules, that ensures financial integrity by making sure that the sources of those capital raised are legitimate, and to also avoid instances where funds are harnessed from within the banking system as fresh capital, which will result to bubble capital, which of course is injurious to the banking system. The essence is to ensure that our banks are adequately capitalized and that the banking system is sound and safe to enhance and engender the confidence of the Nigerian public in our banking system, as well as to encourage investment into the Nigerian economy, given that a sound, stable, and viable banking system is a requirement that investors look out for in investing in other climes.
They added that a total of 4.65 trillion naira was raised over the 24 months exercise, with capital adequacy ratios across the sector now above base benchmarks, reinforcing banks' capacity to support economic growth and absorb shocks.
Out of the money we've raised, which is over 4 trillion naira, I understand that roughly 28% of that comes from overseas investments.
The program also recorded strong domestic investor participation, with 72.55% of the capital raised sourced locally, highlighting growing confidence among Nigerian investors in the banking sector. According to the CBN, the recapitalization was executed without disruption to banking operations, while a limited number of institutions remain under regulatory and judicial review within existing supervisory frameworks.